Hello, everyone. Happy Saturday morning. My name is Derek Clifford. I am the CEO and founder of Elevate Equity, and I'm so excited that you're here with us, spending a little small portion of your Saturday this weekend to get educated about real estate investing, how it works, and how you can use it to your advantage. And today is one of the topics that a lot of people get confused and frustrated about, or just kind of altogether avoid, which is taxes, how real estate investing can help improve your tax situation, and what the advantages of investing in real estate can do for you tax-wise. A lot of people don't even understand how important it can be for your overall investment strategy. And so we're going to dive into that just a little bit here today. But first of all, when we start, I just want to make sure that everyone knows, and it's very clear, that I am not a CPA. I am not a tax professional. So please don't look to me as someone who is the end all be all for all tax advice. All the education that I'm providing here today is purely educational, and it's for you to take to your tax professional so that you can vet out and make sure it fits with your situation. But I'm just here to help explain to you what I've been finding in my experiences I've been investing throughout the years, okay? So first thing that I wanted to talk about here today is why we need to look at tax planning. We spend so much money here in the United States, at least, in taxes. When we work our W-2 job, a lot of the money we don't even see goes out. It goes out before we even collect anything. And so if you own a small business, then you can even relate further, because instead of having the money come out right away, unless you elect for it, you've got to pay for the taxes after you've claimed the income. In some cases, the next year, because the previous year's taxes are due in April of the following. So that can be a big burden if you're not planned out and you don't have a good tax strategy to mitigate some of your gains. Okay, so let's talk about the three things that real estate has been providing for me, at least over the last couple of years. Okay, it is leverage, expense write-offs, and depreciation. These things are really, really important, and we're going to go through each one of them to help describe how we can take advantage of some of these using real estate as a vehicle to do that, okay? So the first thing that we're going to talk about is leverage, all right? Using leverage, you can get into real estate, first of all, for only 25 to 20% down on a property. And what happens is if that property ends up gaining in value, let's say that you buy a property for $100,000, right? You put $25,000 down. Let's say that property goes to 150 or 200,000 over the course of a couple of years, or 3 years, 4 years, however long it takes, right? The cool thing about using real estate investing is that when you have a property, you can put leverage on it, and the income that you get out, if you do a refinance, right? Let's say, it's now worth 200,000, but your mortgage is only 75K because you bought it at 100. And so you've been paying down the mortgage, you've been paying it on time. That means that the new value of the property is 200K. So you can borrow 75% of now the 200K, which means 150 you can take out, right? So if you take out the 150 and you pay off the 75 that you owed from the previous, that leaves you with a profit of about 75K. And that 75K goes into your pocket tax-free because you are borrowing money instead of collecting income. So that means that you don't have to pay taxes on that income coming in. As a matter of fact, which we're going to talk about in just the next bullet point, it actually works out in your favor tax-wise, as long as it makes sense business-wise for you, where you're making enough income to be able to offset the increased leverage that you're about to take out, because you got to pay that back in the mortgage, right? But with interest rates being so low these days, it seems to be a really great way to tap into equity and be able to pull money out and put it to use in other properties or in other investments, or to just use as fund money, okay? So that's leverage. The next thing is expense write-offs. This is huge because being able to take all of the expenses that are related to your property, you're only paying taxes on your profit. So if you have an income coming in from all of your rental properties, right? And then you have, let's say you've got like an AC to fix, or you've got property management, you always have property taxes and insurance to pay. So all those things come off the bottom line. So the total income that you're collecting in, you don't have to pay taxes on all of the income. It's just the amount that comes after you pay all of your expenses. That's the profit. That's the only fair thing to do that the United States government helps set us up with. And that includes what we were just talking about in the leverage piece of this video. That includes mortgaging and financing. So whatever your mortgage costs are, they become a detractor of your profit. And so the more leverage you take out, it's considered an expense. And so in some cases, if you really need to do that, you can leverage all the way up to the point where you're taking zero income technically from the property, even though you're collecting cash flow, it's appreciating in value, and you have all these great assets on paper that you're holding that are going up in value, right? And as you get more income, you can afford to pay more leverage, and you can pull that money out tax-free, okay? So that's the kind of the combination of the previous one, which is leverage plus the expense write-offs here. Hopefully that makes sense. And then the last one is really something that is harder for most people to understand, but we're going to try to break it down here real quick in about a minute. Depreciation is the realization that the IRS allows you to, as an expense, use up your property. So let's say that you buy a house, right, that you're in, and you're living in the house, and it starts getting used up because you're living in it. In the United States, we allow 27 and a half year straight lines. So that means that whatever the value of the property or the building is worth, you can take 127.5%, or not percent, but one over 27.5 every single year for 27 and a half years. And you get to depreciate 127.5 over the course of that many years, right? To depreciate your property. So if you have a property that's worth $1 million, right, then that can be quite a lot of money. That's about around 50 to, I can't actually do the math in my head, but it's a significant amount of money that you're able to write off every year and put that in the bottom line, which means most likely when you're collecting income off of your property, your depreciation should be offsetting a lot of your gains, so that in the end, you're not really paying taxes at all on any of the income coming in from your property, because the depreciation, along with all the other expenses like financing, property taxes, mortgage, everything else, that's on adding on top of it. So most likely, at least in my experience, I've been finding that I don't have to pay too much taxes on any of it, because I have the depreciation on the back end to also help lower the basis of that income, so that it's basically income that comes in to your pocket without having to pay the taxes on it, or at least you're depreciating it. So you will have to pay it back afterwards when you sell the property. But if you're going to be holding a property for a long period of time or doing a 1031 exchange, that's another thing that you could do. You would be able to basically enjoy that. There's a 1031 exchange as well. So 1031 exchange is simply when you buy a property, it's a rental property. It can't be a private residence, but you purchase the property as a rental. And then when you sell the property, you flag a 1031 exchange and saying that you're going to be buying more real estate. And as long as you buy properties that are worth more than the value of the property that you're selling, then you're going to be allowed to not have to pay any capital gains if you have any. So in that same case where you had $100,000 property that you bought, and then it's now worth $200,000, and instead of refinancing and enjoying the money coming out to you to use however you'd like, you can sell the property for everything that you have. And then if you roll it into more property or more real estate, there's a capital gain there that you had of $100,000, right? Because you bought it for 100 and you're selling for 200, and you're deferring that to the future. So you're actually moving that gain into more property, and then eventually you'll have to pay that back, right? Unless you have some good estate planning and you can pass along to your heirs without paying the taxes on it at a stepped up basis. That's a little bit more of an advanced technique, but definitely something that you should talk with on your tax strategy. And the last thing that I wanted to mention here in regards to taxes is that a lot of people don't understand that you should have a tax strategy when it comes to your investment portfolio. Because if you're buying stocks and bonds, right, and you're just paying X price for it, and then it goes up in value, or you end up collecting dividends and you got to pay taxes on that gain, right? Think about the fact that you could offset that with losses on real estate that you could take. That means that the tax bill that you're paying could be negative, or it could be zero, depending on how you do this, right? So if you have real estate in your portfolio and that's a tax write-off versus the capital gains that you have, that's a tax liability, then you can kind of combine the two and offset them so that you don't have any type of taxable gain. And this is something that a lot of sophisticated investors are always looking for. They're looking for ways to cut their taxes because they're making lots of money in capital gains or buying and selling businesses. And the IRS deserves their fair share of it. But if you can offset that with depreciation, with leverage, or with write-offs, that's exactly what you should be doing as a healthy part of your financial portfolio, okay? And one last thing I wanted to add about this, I know we talked about a lot. We talked about leverage, we talked about expense write-offs, we talked about depreciation, and even went a little bit into 1031 exchanges. I wanted to also bring up the fact that multifamily real estate itself has got an extra special way of capitalizing on tax savings, because when you buy a single family house, you have the 127.5, straight line depreciation you can take. But in an apartment building, it actually makes sense because there's enough income coming in from the building to pay for an engineer, pay like $3,000-$4,000 for an engineer to go to the building and start counting up the beams and the bricks and the refrigerators, the appliances, all that stuff. You add it all up, and then you're able to depreciate. Instead of 27 and a half years, you can depreciate it in 12 to 5 years. So that means that your depreciation bonus goes even higher. And then you can use that, since it trickles through to your personal portfolio, to help offset some other capital gains that you may have elsewhere in your portfolio. And so multifamily real estate, because of that economy of scale, it's got an extra special advantage there for that. And one thing, too, that I want you to add is that if you are interested in learning more about this and how multifamily real estate can help create and build your passive income wealth over a long period of time, please click the link in the show description here, because that will get you to a free gift that I want to offer to all of you guys that'll show you what are the 7 ways in which commercial real estate can help build wealth for you over the long term. And you'll see that depreciation is one of those things, but that's just one small feature that you can get. And if you work with experienced operators who know how to deploy capital in these areas, you can partner with them and gain equity in these buildings without doing any of the work, right? If you're a busy, married, professional, it's very, very hard to find the time to do that, but it's very much worthwhile. So that being said, you guys, that's everything I wanted to talk about in terms of taxes. It's super important to consider that as an overall balanced strategy and looking at your portfolio and your investment portfolio. And so if you're not doing tax planning, then that's something that needs to be looked at, because you're doing yourself a disservice by paying more taxes than you should be to the government. So anyway, that's everything I have for today. If there's any questions you guys have, please reach out to me in the comments. Please like and subscribe wherever you're seeing this. I really appreciate all of your support. And with that, I'll go ahead and end out the stream, and I'll let you resume the rest of your Saturday. Have a fantastic weekend. Take care, everyone.